Maybe you don't have a problem with margins. You do have cash flow. The question still is, what do you do with that money? Are you able to reinvest that? Do you want to spend the time to figure out how to reinvest that?
When people invest in the stock market, they don't want to look at it. It's just going to grow over time. You may as well put it in some type of real estate syndication or some type of real estate fund, because there is more upside and it tends to beat the stock market historically.
After several conversations with real developers, you realize, oh, that's my dollar that's being wasted if I do this the wrong way.
At that given time, it's not like rents are really going to come down. It's filling up faster than anyone could have imagined. I mean, that's where everyone wants to be. And they're charging close to $5.50 a foot. The capital stack, right? And the capital stack for real estate development and all real estate. So that's essentially how you finance the project, and there's a lot of nuances to the whole thing. So I don't know if you want to start off by explaining what the capital stack even is for people that may not understand the terminology.
Yeah. So a lot of times when people think about real estate or development in general, they know that they have to get investors, and they know that they have to get a loan, right? And so the debt and the equity, right? And so that tends to be the capital stack in its most basic form. Is just what's the debt, what's the equity, and how are you financing the project in general? Like, how are you getting the money to actually do it or to acquire it, right? So it's not just exclusive to development, it's also for any type of real estate. And the more complex side of it is like, how do you slice up those pieces, right? So how many different types of investors do you get? How many different types of loans do you get? You know, first lien, second lien. You can get really complicated and technical, but in the most basic form, capital stack just means the equity and the debt, or the investors and the loans.
Yeah. And in development, in all real estate, it's over time. But in development, because we do ground up construction, and that's a long process where you have to buy the land, you have to do all of the hard costs, and then finally finish the project, either refinance or sell the whole thing. Meanwhile, an existing building still needs to be financed, still needs some type of capital stack to purchase, right? So it's a little bit of a cat and mouse game when you're trying to spend money off the bat in development. So I don't know if you want to explain how the capital stack is spent over time, some of the first dollars that go in, some of the first dollars that come out, right? And how that works.
Yeah, at the very beginning of a project, you typically call it the project sponsor, or in our case, the developer, or whoever is leading the project, who's got the idea to put something together. So they'll do whatever their in-house expenses are, right? So there are overhead things that they have to deal with initially that's not even necessarily specifically project related, that you're not going to bill back to any of your investors on a project basis. You'll invest the time and the effort into it, and then you really start to spend money when you are hiring third parties to come in and do different things. And that starts obviously with the sponsor's money first. And so like right now we're under contract on a new project, and we have our deposit, right, which is refundable to begin with. And most of the time that's the case, is you have a refundable deposit that you come in with. And then you have to spend money on things like a civil engineer in the case of development, or inspectors if you're buying something that's existing, surveyors, things like that. So all of your really preliminary due diligence money tends to come from the project sponsor. And then at that same time, depending on what your relationship is with your previous partners or partners that you might be thinking about working with, then you can start to layer on additional kind of needs from there.
Yeah, and from a risk profile, the first dollars that go in are the riskiest, but also have the highest return. Also, with that being said, the first dollars that go in are, in many cases, the last dollars that come out. So I don't know if you want to explain the risk profiles as a project progresses, and which type of finance group would come in at a specific time period.
Yeah, like you said, the first dollars in are not necessarily the first dollars out. Because it's a sponsor, you want to have alignment. You want to have alignment between what your incentives are for your sponsor at the beginning of the project and all the way through to the end. Because if the sponsor is just taking their fees and they're the first ones that get paid, then you're going to end up in a situation where at the end, the investors are kind of left holding the bag for a project that they didn't have complete control over. So to align your incentives, the sponsor puts their money in first. That shows the commitment that they've come in with. And then at the end of the project, they're going to have, a lot of times you'll have a preferred return that is essentially a guarantee from the sponsor that the first dollars that come back are going to have a return. You're going to return the investors' money first, and then you're going to give them a preferred return that's anywhere from 8 to 12 to 15% in a lot of cases.
Yeah.
And then kind of to follow on to your second part of your question about who comes in at the different stages, like who would be the first people in that want to take more risk, is the equity partners that are going to, sometimes you'll call them a co-GP, that are going to come in and receive part of that second piece, right? So that last return, the project sponsor might only have a smaller percentage to begin with. They bring in a co-GP to help finish with the acquisition of the property, with the initial soft costs, things like that. And in exchange for participating at the early stage, you're also going to give them an outsized return at the end, or like part of the promote, a higher pref. There are a lot of different ways that you can structure it to, again, align the incentives and reward people for the risk that they're taking earlier on in a project.
Yeah, and then just how finance works generally when we're looking for now, some of the last pieces of the equity and the debt, you almost don't want to start drawing from a pref equity piece or the debt until maybe you're about to completely start construction, because if there's any holdup in that, the pref or the actual debt interest starts accruing. So I don't know if you want to explain how you think about that kind of cat and mouse game when you're looking at the schedule and how the capital markets are working in real time, and also along with the actual real estate market and how to just time it. I know it's different asset class to asset class, but again, generally, how do you look at when you want to bring in these groups and how to wait to start spending their dollars because it's gonna start accruing and going to start growing in a sense?
The way that I think about it is not just in terms of pref equity or debt or anything like that. It's really more about all money has a time value associated with it, including the sponsor money. So the slower that you can spend the money while still advancing the project on as quick of a schedule as you can make it, that makes everybody more money. And so that's really the game, is seeing how can you keep your expenses low while pushing the project as far forward as possible and achieving the certain types of milestones that you need to achieve, like having your full set of construction documents. There's no avoiding having a full set of construction documents or getting a permit before you start construction. So there's going to be a point where you have to accelerate your spending, right? So whether it's sponsored dollars, your pref equity, or LP money that has a preferred return on it, or it's real debt that's coming in, you're trying to keep those costs low while still understanding that you have a contract amount that is going to be fulfilled at a certain milestone. And so the way that I know we model it is off of a bell curve or some sort of a curve method within the cash flow on a month-by-month basis initially. And then we're tracking in real time every month, are we staying under that monthly cash flow expectation that we had and increasing our return essentially and increasing our partner's return. And so that's the way that I look at really the cash flow, is just trying to preserve the return for everyone, and then secondarily on a milestone basis for the full contract amount, and then I think the next piece that you were asking is like, when do you bring in the different partners? I think that that's a bigger piece or a bigger part of a discussion around what comfort level do the different groups have to come in based on the milestones that you've achieved.
Yeah. So, and then just for the audience, I don't know if you would like to touch on, you mentioned pref equity, and we're talking about interest and even an internal rate of return, right? I like to think about it when we're looking at a return standpoint. Someone could say, I'll double your money, but it's a big difference if they could double your money in 2 years, or they could double your money in 10 years, right? So I don't know if you want to just touch on the time value of money. And I know you were explaining how as the project accelerates, you'll start bringing in that actual accrued capital. But if you could just briefly mention.
Yeah. I mean, you're running the calculations more often than I am at this point, but the time value of money, I think everybody understands to some extent, even if they're not using MBA level calculations or running it in an Excel model, right? The formulas even that you learn in school aren't necessarily the way that people are putting it through a model, because we just have the advanced technology that tells us the answers, that you can really just put it in a pretty simple calculator and do comparisons. And that's what I think people should be doing just for themselves, is to run some different scenarios of, if I put money into stock market and I don't touch it, or I put money into a stock market that gets dividends that get reinvested, or I put money into a triple net retail investment, and what do I do with that money? Do I then take all that cash flow and put it in the stock market? Or in our case, the less liquid side of things, on development, you put money in and you're waiting for that big return at the end. And it might be a year and a half, might be 2 years, might be 3 years, depending on the project that you're going into.